If you have $1,000 right now and you are waiting for the market to calm down before you invest it, this video is going to change how you think about that decision. Here is the uncomfortable truth nobody tells beginners. The market is always uncertain. In 2020, it was a global pandemic. In 2022, it was the fastest inflation in 40 years. Right now, in 2026, it is tariffs, energy price volatility, sticky inflation, and a Federal Reserve that has held rates steady for most of this year. There will always be a reason to wait. And waiting, as we will show you with actual numbers in this video, has historically been one of the most expensive decisions a first-time investor ever makes. Here is what this video covers: what to do before you invest a single dollar, where to put the money, what to buy inside the account, how to open the account in 15 minutes, and what to do when the market drops after you invest, because at some point, it will. No jargon, no product recommendations, just the steps, the math, and the honest answers for 2026. Everything in this video is for educational purposes only. Nothing here is personalized investment advice. All data is sourced from publicly available records. Links are in the description. Please consult a licensed financial advisor before making significant financial decisions. Most people skip straight to the part about what to buy. That is the wrong first question. And if you get the 3 questions I am about to cover wrong, the market is not your problem. Your own financial foundation is. Stay with me through part 1. It is 60 seconds. And it might be the most valuable 60 seconds in this video. Before your $1,000 goes anywhere near the market, 3 questions determine whether investing right now is actually the right move for you. Question 1. Do you have an emergency fund? If you invest today and face an unexpected expense next month, a car repair, a medical bill, anything, you have 2 choices: go into high-interest debt, or sell your investment at a possible loss to cover it. Either way, you lose. High-yield savings accounts in May 2026 are paying between 4 and 5% APY. Check the links in the description for current rates, as these move frequently. That is real, risk-free return on money that stays accessible same day. 3 to 6 months of essential expenses should sit there before any investing happens. Not there yet. The $1,000 goes into savings first. Question 2. Do you carry high-interest debt? Pure mathematics. Paying off a credit card at 20 to 24% APR is a guaranteed 20 to 24% return. No investment can promise that with certainty. Above roughly 8% interest, pay it down first. Below that, invest. Question 3. Does your employer offer a 401k match? A 3% employer match on a 3% contribution is a 100% instant return. Nothing in investing beats that. The 2026 employee 401k limit is $24,500 per IRS guidance, linked in the description. Your only number right now is whatever percentage your employer will match. 3 gates cleared? Your $1,000 is genuinely ready. The next section is where most people make their second mistake. They ask what to buy. But the account you hold your investment inside can matter more than the investment itself over a 30-year timeline. Same fund, same return. Completely different outcome, just because of taxes. Part 2. 2 minutes. The account matters more than the investment over a long timeline, so let us get the account right first. Option 1. The Roth IRA. For most beginners in 2026, this is the right first account. You contribute money you have already paid taxes on. It grows completely tax-free. Qualified withdrawals in retirement are tax-free. No tax drag on dividends every year. No capital gains bill when you sell decades from now. Who qualifies? Most beginners watching this will qualify. Verify your income limits at irs.gov before contributing. Link is in the description. The 2026 Roth IRA contribution limit is $7,500 per year under age 50, $8,600 for those 50 and older. How to open one right now. Go to Fidelity.com, Vanguard.com, or Schwab.com. Click Open an Account. Select Roth IRA. Enter your Social Security number, basic information, and link your checking account. No minimum deposit required at any of those 3 platforms. 15 minutes. That is it. Option 2, the taxable brokerage account. Already maxed your Roth or need full flexibility to access money before retirement with no restrictions? A taxable brokerage account is the next step. You will pay taxes on dividends annually and capital gains when you sell. The trade-off is total liquidity, no age restrictions, no penalties. The priority order: 401k match first, Roth IRA second, taxable brokerage third. Now, what do you actually buy inside the account? Most people expect a complicated answer, hours of research, dozens of options. The data says the opposite, 90 seconds. Simpler than you think. Part 3. For a first-time investor with $1,000, the answer is one fund. One broad market index fund. That is it. A broad market index fund owns a small slice of hundreds, sometimes thousands of companies at once. One purchase. Instant diversification across the entire economy: technology, healthcare, finance, consumer goods. And the data consistently confirms this approach. The S&P Dow Jones SPIVA scorecard, linked in the description, shows that over a 15-year period, more than 90% of actively managed U.S. funds underperform their benchmark index. Not some, not most, more than 90%. So when you choose a low-cost index fund, you are not settling for average. You are choosing the approach that beats the overwhelming majority of professional fund managers over the long run. The most common starting option is VTI, Vanguard Total Stock Market ETF. It tracks the entire U.S. stock market, roughly 3,500 companies, from the largest down to small caps. Expense ratio, 0.03% per year, the widest possible slice of the U.S. economy in a single fund. 2 close alternatives: VOO, Vanguard's S&P 500 ETF, same 0.03% expense ratio, but tracks only the 500 largest U.S. companies. Still covers around 80% of the total U.S. market by value. FSKAX, Fidelity's equivalent of VTI, with an even lower expense ratio of 0.02%, available only inside Fidelity accounts. The honest answer on which to choose: it barely matters. The performance gap between VTI and VOO over the past decade on a $10,000 investment has been under $200. Expense ratio under 0.1%. You are in the right category. What about bonds? Timeline of 10 or more years and you can stomach a 30% temporary drop? 100% equities is the stronger starting position. Shorter timeline, or you would panic sell. An 80-20 equity and bond split smooths the ride. A bond fund like BND, Vanguard Total Bond Market ETF, adds that cushion. In a bad year, an all-equity portfolio might drop 35%, and 80-20 might drop 25%. For some investors, that 10% difference is what keeps them in the market instead of selling at the bottom. The best allocation is not the one with the highest expected return. It is the one you will actually hold through a rough year. What about individual stocks? With $1,000, put $500 into a single company, it drops 30% on one earnings miss, which happens regularly, even to well-known names, and you have lost 15% of your entire portfolio in one afternoon. An index fund distributes that risk across hundreds of companies. One bad quarterly report barely registers. Individual stocks come later, once the foundation is larger, not now. The next question every new investor asks is the one that trips up the most people. All in today or spread it out? The research has a clear answer, with one important human footnote that changes the practical advice for most people. Part 4, 90 seconds. All in now or spread it out? Clear. Data first, then the human truth. Should you invest all $1,000 at once or spread it over several months? Vanguard's research, analyzing more than 4 decades of market data
Lump sum
across the
investing grew
US,
steadily, while
UK,
dollar
and
cost averaging
Australia,
smooths the power
linked
of
in the
compounding over
description,
time.
shows that lump sum investing has historically outperformed spreading it out roughly 2/3 of the time. The reason is simple. Markets rise more often than they fall. The sooner your money is working, the longer it compounds. Holding cash waiting for a better moment is itself a cost. The 2026 context. Charles Schwab's 2026 U.S. Stocks and Economic Outlook, linked in the description, describes the current environment as one of instability. Rapid tariff policy shifts, markets affecting sectors unevenly, elevated volatility expected through the year. That does not change the long-run mathematics, but it speaks to psychology, and psychology is where most investors lose money. Dollar cost averaging, $200 a month for 5 months, will not usually win on returns, but it wins on behavior. Investors who spread their entry are less likely to panic sell if the market dips the week after they invest. And panic selling at the wrong moment is the single behavior that most permanently destroys long-term returns. Practical answer for a nervous first-time investor: invest half today, automate the rest monthly. Look for automatic investments or recurring contributions in your brokerage account settings. Under 2 minutes to set up. The next part is where most investors fail, not because they picked the wrong fund, not because of timing, because of one specific moment. A Tuesday morning when the account shows a number smaller than what they put in, and they do something. What you do in that moment determines more of your long-term return than almost any other decision you will make. Part 5. This is the most important section in this video. The market will drop after you invest. Not maybe, eventually. And when it does, when your $1,000 becomes $820 on a Tuesday morning, you will feel a pull to sell, to move to cash, to wait it out. Here is what the data says. U.S. equity markets have delivered positive returns in roughly 70 to 75% of all 12-month periods historically. Every major downturn, 2001, 2008, 2020, recovered. Investors who stayed in recovered with it. Investors who sold during the decline locked in permanent losses and watched the market reach new highs without them. A $1,000 investment that drops to $800 is not a loss until you sell it. It is a temporary number on a screen inside a long-term account. Vanguard's behavioral research and Morningstar's annual Mind the Gap study, both linked in the description, confirm the same finding. Investors consistently earn less than the funds they own because they buy high and sell low in response to short-term movement. The more frequently you watch the account, the more likely you are to react. Reaction is how ordinary investors destroy the returns compounding was building for them. If you know you would sell during a drop, that is useful information about your allocation. An 80-20 split drops less in a bad year. A portfolio you hold through a crash is worth more than an aggressive one you abandon at the bottom. Everything covered in this video comes down to 7 steps. Right order, no ambiguity, and at the end, one number that makes the cost of waiting impossible to argue with. Part 6, 90 seconds. 7 steps. Clear order. Step 1, no emergency fund, high yield savings account, 4 to 5% APY as of May 2026. Current rates in the description. 3 to 6 months of expenses. Build it first. Step 2, debt above 8% APR, pay it down first. Guaranteed return beats uncertain market return every time. Step 3, Capture your employer's 401k match. The 2026 employee limit is $24,500. Your only number is whatever percentage they match. Step 4. Open a Roth IRA. Most beginners qualify. Verify at irs.gov before contributing. The 2026 limit is $7,500 under 50, $8,600 for 50 and older. Fidelity.com, Vanguard.com, or Schwab.com. Open account. Select Roth IRA. Link checking. 15 minutes. No minimum deposit. Step 5. Buy one low-cost broad market index fund, VTI, VOO, or FSKAX. Expense ratio under 0.1%. One fund is enough. Step 6. Set up automatic monthly contributions, even $50. Automatic investments or recurring contributions in your brokerage settings, under 2 minutes. Consistency builds wealth. Amount matters less than habit. Step 7. Close the application. Calendar reminder, 12 months from now. Check then, not before. Investors who check less frequently earn closer to what their funds actually return because they are not reacting to noise. Checking quarterly beats checking daily. Not checking beats both. 7 steps. Done. Here is the number that makes this personal. $1,000 invested today at 8% average annual returns over 30 years becomes approximately $10,000. The same $1,000 invested 5 years from now becomes approximately $6,800. Same money, same market. The only difference is when you started. That is a $3,200 gap before you add a single extra dollar, purely the cost of waiting. The market in 2026 is uncertain. It was uncertain last year. It will be uncertain in 2030. The investors who build real wealth are not the ones who found the perfect entry point. They are the ones who started with what they had, kept costs low, stayed inside tax-advantaged accounts, and did not sell when things felt uncomfortable. The best time to start was yesterday. The second best time is this week. Every source in this video is linked in the description. All public, all current. None of it written to sell you a product. If this gave you a clear first step, subscribe.